Okay, thank you everyone for joining us for this panel about liquidity. We have some incredible speakers here. So what I'll do is have each of them introduce themselves first briefly, and then we've got some really great questions prepared, and we'll do some Q&A at the end as well. So if you do have burning questions, be sure to keep them in your back pocket. With that, start with you.
Great. Well, great to be here, and thank you for inviting me. My name is Michael Harris. I'm Vice Chairman at the New York Stock Exchange. And I have a couple different roles there. One is running our global capital markets team, which is focused on working with companies who are private that are in the process of coming to the public markets. Prior to this, I led capital markets at Citadel Securities, which is a large liquidity provider across U.S. markets and also now more globally. And had spent most of my career as an investment banker, mostly covering fintech and also financials, but spent a little bit of time on the buy side as well at Morgan Stanley.
I'm Ekaterina Almasque. I'm co-founder of BlankPage Capital, which is a growth venture capital platform based here in the UK. I have been investing in venture capital since about 20 years. Several companies of my early investments went IPO, luckily many in New York, some in Europe, in Sweden. But actually it's a very interesting journey. So yeah, go ahead.
Thanks very much. Good afternoon, ladies and gents. It's lovely to see you all. My name is Shah. I head up coverage of the technology sector at the London Stock Exchange, and what that involves is, very similarly to Michael, helping companies go public on our markets, also for private companies, helping them use our brand new private securities market to attain liquidity. I was a banker for about 20 years prior to this, doing a lot of M&A and IPOs on multiple markets, and great to be here. Thanks. John?
Hi, everybody. Can everyone at the back hear? I'm just conscious it's a little bit noisy. You can hear? Good, brilliant. So John Cordrey, I'm a principal at Foresight Private Equity. We're a £14 billion fund, assets under management. We do checks of 250k up to 20 million into UK and Irish SMEs, usually helping them scale overseas. These are usually taking their first liquidity investment rounds. We also provide cash out as well to people wanting to de-risk. Prior to that, I was at Inflection doing sort of 100 mil type investments, and a former founder prior to that, and a boring accountant, but I won't go into that.
Awesome, thank you everyone. And I forgot to say, my name is Meagan Loyst. I'm the founder of Gen Z VCs, the largest community of Gen Z investors and founders globally. And just really excited to dive into this panel. I think we have a really unique I would say contrast here, right? We've got the New York Stock Exchange, we've got the London Stock Exchange. So maybe let's start with liquidity here in Europe. So we've had, there's plenty of billion-dollar companies here in Europe, but very few landmark public listings here. So maybe let's start with why that is, who's responsible, and who in this room is really going to help sort of fix that over the next couple of years.
Happy to start there, Megan. I think, when I was a banker, I think a lot of companies, aspired to be sold, and people would take that £5 or £10 million check. So I think that, historically, it's been a bit of an ambition problem. But what we've seen recently is more and more companies looking to IPO, Raspberry Pi. We've seen companies like Synthesia turn down a $4 billion offer from Adobe, right? People want to go longer and harder and, go the full way. The other thing is that debt's been cheap, private market's been hot. That's allowed, a lot of valuations to be sustained with the help of structure. Some of that's starting to unwind now, which creates tremendous opportunity, I think, for people like Michael and me to help these companies and the VCs behind them attain liquidity. So I see it really as a massive opportunity. There's no shortage of supply, a massive pipeline.
Yeah. Michael, anything to add?
No, I would agree with that. I think one thing that's interesting is and we'll probably talk a little bit about this later, is just, the structure of markets publicly has changed quite a bit. And, I think the point that was brought up earlier, there is an abundance of private capital that's available. I think in many respects, that's great for companies that are private. It offers them an abundance of choice. But at the same time, as you get to later and later stages of funding rounds, what you're seeing is even for companies at the extreme levels, companies like SpaceX or companies like OpenAI, there comes a point when there is a need to scale, and the public markets offer that ability to do that. So as we look at opportunities for companies that are private, that are not the size of SpaceX, there are an abundance of areas where we think the investor base is deep enough that it offers them that opportunity.
Awesome. And so maybe let's circle back to you, Neil, for a second. You guys have, for the London Stock Exchange, you've reformed your listing rules, you've launched Pisces. Maybe explain to the audience what that is and how transformative it is. And you've also made the public case for being a tech listing destination. So can you talk a little bit about what the London Stock Exchange offers European companies today?
Sure. So I think the biggest change in most recent times is giving founders more agency, right? If you want to stay private, you can absolutely do that. Historically, companies have faced cliff edges when they needed liquidity. That's what resulted in some of these forced sells. But now with Pisces, you can go public for a day, remain a limited company, offer shares for sale to all sorts of investors in a controlled manner, where the company has control of who's selling, who's buying, what the price is. And this new market makes this process so much more repeatable, so much more convenient. You don't have to sign 50 sale and purchase agreements to conduct these sales. It's settled into Crest. It's also got some attractive tax breaks. So we had our first trade in March for Oxford Science Enterprises, the deep tech fund. We've got a few more trades coming, hopefully pre-summer. So I'm really excited to be able to tell you about those pretty soon. And then in terms of public markets, I think one of London's strengths historically is that we've always been able to take companies large and small public. In December, I had a Dubai-based media business, $13 million of revenue that we took public on our AIM market because that was the right decision for that company. It didn't fit into the classic VC model. But of course, if you've got later stage companies, take a dark trades at 200 million, we've got our main market. And we can offer these companies index inclusion. So if you're a unicorn, that's a FTSE 250. If you're a decacorn, that's a FTSE 100. You can be a British company, you could be an international company like Bank of Georgia, Lion Finance that joined us with about $230 million of market cap 20 years ago. Today it's a £5 billion company in the FTSE 100 with access to global investors. And London's open to international investors. So when Shawbrook Bank did their IPO, about £400 million was raised. That book was 7 times oversubscribed. 38% of the demand came out of North America. So there's a lot you can do from here.
Awesome. And so I'm from New York. I'm living here in London. I do feel like I'm trying to be as partial as possible here. Michael, maybe could you give me a little some insight into, obviously you guys are the world's largest stock exchange. What does New York offer to European companies that are trying to publicly list? And on top of that, well, why should they list with you? But also, what does that say about the ability for Europe and to be a self-sustaining public tech market coming to New York?
Sure. I think it's important to think about this in terms of the context of just the current state of the market. So if you look at Europe, there's been kind of both in the UK and across the continent about roughly over the last 5 years, about $100 billion worth of capital in terms of public companies that have migrated from being listed in Europe to the US. Part of that is, I think, driven by a few different structural factors that are at play. But what it's really doing is, as you kind of look at the broader trend of just where capital markets are now, you've seen a significant amount of outperformance in US markets. But ultimately, and kind of going back to some of the same themes that I think Neil mentioned, the US markets, just as far as capital has been raised, IPO markets are at a really robust level of performance, roughly about 2x the amount of capital that's been raised this year relative to last year, both in terms of number and also in terms of dollars. You're also seeing, in terms of just the overall performance of IPOs, double-digit returns, roughly around 20% for the average IPO. And that's not including the very large pipeline that's been very well written about in terms of companies like SpaceX and OpenAI and the others. So the overall pipeline of issuance has been significant. Even if you look at the overall ECM pipeline, follow-on offerings, convertibles, IPOs, it's been about $120 billion worth of capital that's been raised. And what I think that really points to is kind of 3 different structural issues. On one hand, it's just liquidity. And then when you look at just the amount of liquidity in the US markets, there is typically on a normal trading day more than $1 trillion that trades hands in the US markets. That's multiples of what you see in any European venue. The second part of that is one of the reasons why you see that is that from the standpoint of the investment pool, you have the largest mutual funds, the largest ETFs, the largest growth equity investors, the largest crossover investors, and the largest hedge funds that are all, for the most part, located in the US markets. And all that leads to a liquidity shift where if you are running a company and you're looking to have global ambitions and you want to have a global growth profile with the deepest pool of investors, the US markets are where you tend to go in order to do that. I think what's interesting, though, is when you look at the backdrop and you look at where Europe is, and it's not necessarily a creation problem for companies. There's a recent McKinsey report that looked at, even if you look at the narrow slice within SaaS, there's about 300 companies that are all doing north of 100 million worth of ARR in euros. And so it's not necessarily a creation problem, it's a retention problem. And what happens is that you see a lot of companies when they do get to a certain scale and they are looking to actually go global and get a global comp group to be compared to, the US pool of investors, the US community of investors tends to be the one that tends to support that growth over the long term.
Super interesting. And maybe shifting a little bit, Ekaterina, if you could kind of talk about, when a founder is choosing to go after an exit, whether it is an IPO, secondary sale, M&A, how much does venue choice actually matter? Or how much is this coming up in conversations to go public in New York, go public in London?
Well, it's a good question, and I think those who invest in this room, they know the challenge we are facing in the board meetings and in conversation with the founders. So what we want as board members, as investors, is the best future for the company, right? So what we want to ensure is that once they go IPO, the journey doesn't stop. Yes, we as investors, we get payout, hopefully, but it's not the reason we decide to go for IPO. The reason to go for IPO is to ensure a long-term journey of this company and ability of this company to raise money from public markets in the long term and continue to grow. So in many cases, actually, it makes sense for the company to stay in Europe. For example, the company is in defense sector, so I'm investing in quantum computing. Actually, it would make sense for these companies to stay European. And we have a lot of this conversation, like, shall we stay in Europe? And you have seen probably one of the largest IPOs this year was in Amsterdam, and it was a defense company from the Czech Republic. So yes, it happens this way. On the other hand, what we have is that, unfortunately, the past track record, and it's not, as we always say, and what we heard today in the LP panel, is not the prediction of future success, but unfortunately, when we see the past, we see the struggle of those companies going in Europe, not necessarily in London, but in some other European stock exchange, to raise money long term. And the reason for this, there are a lot of structural things, but one big reason is that the typical investor in Europe in public markets is not as educated in the deep tech or technology sector. And I can also give you an example. It happened, and I was very lucky in my early career, I lived in Silicon Valley. It was a time when VMware went public and there was Google just going public and just very early days of Google. And I remember going around and people were talking about, did you buy this stock? Did you buy this stock? What do you think about this? Do you compare? And it was highly technical ventures. Like in London, I live today since 2011, I live in London, and very rarely in conversations and dinners, the topic comes up, like what is the stock price and have you compared and do you want to invest in this? And I think this is a major problem. Why? Is because this is not on the first mind for people to actually go and acquire this stock. And yes, we have some companies that could potentially go in London public, like Revolut. It's pity in some ways that it went in Europe, but it could go, people know Revolut, it's a household name. But there are some other companies that are amazing technology companies that nobody knows about. And until they become household names, it's very difficult to create this very vibrant public market where people are starving to buy this stock. So I think it's a long, very long answer to your question, but I think we as investors, unfortunately, we are not making decisions. What we are trying to make sure is to make sure that the company has long-term future. And we are part of the ecosystem that is still developing. So what we are doing is putting our efforts into developing ecosystem, educating other investors, educating markets, making publicity, but we cannot change it overnight. And until this is developing, and we see already a lot of potential, like, listing in London, but until we see a clear path how to raise money time after time for deeper tech companies in London, I think the choice will still remain, in many cases, to go to New York.
Yeah, that's super interesting. I also just think I'm considering I work with a lot of sort of young investors, both retail investors that are newer to the investing space and broader. It's interesting seeing people get into the investing space through, like, for example, I know, like, has anyone seen the Nancy Pelosi trading bot on Twitter? Like, she's got like 1.5 million followers where people actually follow her trades. So like, she'll invest in random defense company, and then all of a sudden everyone on Twitter, everyone on TikTok is like, wait, what's this defense company? Why is everyone investing in it? So it's been interesting to see that sort of like education start from the bottom up. But maybe shifting a little bit towards valuations for a second. John, you and Foresight have visibility into unlisted and listed strategies. Can you talk a little bit about maybe valuation trends over the past couple years, and how those have developed both in terms of sectors that are interesting, maybe US versus UK, given the sort of demographic of our panel here? Would love your thoughts.
Yeah, so following on from that note, I think at the more grassroots level, so we're typically doing the smaller checks. Companies are coming to us usually about 1 to 10 million ARR, and then we're helping them quadruple. A lot of them, probably going back about 5 years or so, would dream about IPOing. That was their thing, and a lot of boards, you would spend time convincing them maybe trade's a good route as well, maybe you should consider secondary private equity, mainly because of regulatory aspects and the cost aspects. And when you're a small company, you've just written a small check, you don't want them necessarily jumping the gun and spending 200 grand on this and that and finding out. And over time, there's been the British Business Bank and others that have come in to help add liquidity into our market. So there's a lot of venture money in the UK, especially anywhere between check sizes kind of 2 to 10, and there's a bit of a gap below, a bit of a gap above. And then the mid-cap private equity, they're very, very scarce for deals. So there's huge lack of supply for those. And so they are getting better valuations and perhaps not necessarily looking to IPOs as much. On valuations, in terms of sectors, what we've seen is probably since 22, 23, everyone was looking at like blockchain was a thing and NFTs were a thing, and then it's become AI. Yeah. And so now people are talking about, should we be investing in SaaS companies anymore? Should we be applying the same valuation criteria to those and going as gung-ho? And then the other thing that's happened is quite a lot of the funds in the market who were unicorn hunting, candidly, in the UK anyway, spent a lot of money on a lot of red or black gambles, have found out they didn't quite pay out. At the same time, they've kept burning cash, and that was a thing. It was like grow, and then we'll IPO or we'll sell it. Someone in America will buy it. That was kind of the strategy for some funds who shan't be mentioned, and it's not a good one for longevity. So a lot of sectors sort of fall out of that. Obviously, anything consumer tech's not done great. Defense has become big, so a lot of people, certainly in our world and mid-cap, are now sort of unveiling that, oh, we actually quite like defense. I know we told you we didn't like defense and it was taboo, but we'll have a bit of that now. Health tech's still pretty firm. SaaS, I think there's two schools of thought still. So whereas probably 2-3 years ago, a lot of competition for SaaS companies raising cash or selling, people are now sort of pulling out a little earlier or saying actually we'll pay 3 to 7 times ARR rather than 10 times plus. Because I think rightly or wrongly, you'll know better than me, the view is that US buyers are not there in the droves they once were, and maybe IPOs are a bit more critiqued now. They're looking for underlying quality of business, fundamentals, rule of 40 if you're a SaaS company, things like that, rather than just growth. So I think that's broadly what's changed in our world.
Yeah, and I feel like too, if you go a layer deeper, like I've been to like a number of these like sort of private, like where you have a bunch of VC investors in the room, they're all talking about how like gross margins are changing, for example, and how that impacts valuations with, usage-based models really shifting the way that the gross margin profile shows up. It's no longer like 90% is the standard, right? And so that's having an impact as well. Maybe, we've talked a lot about kind of pitting New York against London here. Is there a world, maybe Michael and Neil, you guys can chime in here, where New York and the London Stock Exchange collaborate in some way, whether it's like dual listings, co-created products, shared infrastructure? Like, would love to get your thoughts on that.
Yeah, I mean, I think there's some of that you see already, and I think dual listings are a great example of that. You see a lot of companies that are successful in being able to raise money both in their home market and then also whether it's New York or other markets. I think there is also an element where competition is actually a good thing because it does create an infrastructure for companies to be able to have a choice in terms of where they have the ability to raise capital. I mean, ultimately, for exchange venues, our job is to try to create an efficient path for companies and for founders to try to monetize their stake and raise capital and grow their companies. And that's great for not just, the company, but more importantly for the employees and for the ecosystem. So I think you will see probably increased focus on areas for cooperation. I think one area that will also be interesting is in the areas of tokenization, because that will have a much broader impact as you think about things like settlements, payment rails, and also just the entire aspect around what it means to own a security and what the rules around trading hours even mean. Was it that actually market hours or just 24 hours a day?
Super interesting. Neil?
And then just to add to that, this is the first time Michael and I are actually meeting. And, we probably operate in sometimes we're competing, sometimes we're collaborating. Look, fundamentally, we need to do what's right for the companies. And I think sometimes it's often about sequencing, right? So if I get asked all the time, even last night, $50 million business, he's kind of frustrated with the markets. Oh, we're going to go to New York. Knock yourselves out. That's going to be hard. But I think, when you're at 20 billion, that's a different type of conversation. And maybe there is value in doing a dual listing at that point where you can tap into retail demand in the States that you can't otherwise access for an ADR. But until that point, I think there's a lot that Europe can do to help these companies. I think the tragic thing is, until this point, people haven't been aware of their options. Some of that falls on us to help communicate what options are available. So I encourage you all to learn what those options are. And it's good to have some options, be it private equity, VC. Some areas have been challenging, like deep tech and biotech, but some areas have been fantastic in public markets. Consumer, applied nutrition, beauty tech, some of the best IPOs we've had in recent times. Even trade sales with the sale of Huel recently to Danone. So do make sure you check out your options. There's a lot that's available to you.
So I think, Neil, you are making an excellent point. I think one of the challenges founders are facing is that actually going IPO is a very complex process, and there is very often it's many years of trying to figure out how to actually do it. Listing in New York, although it looks like a very attractive option, actually requires a lot of preparation and very often flipping to the US as a business, and it should happen many years before you go IPO sometimes. And it's very, very costly and very challenging. And I think one of the things that everyone wishes for is having actually this collaboration on transparency and information flow, and actually having a very clear process and an option to list where it's easy and makes sense.
Awesome. Well, Neil, you brought up private equity, and it's come up a couple times in the panel. I'd love to kind of open this up to all of you guys. So PE has become one of the biggest exit routes for venture-backed companies. Think take privates, secondary buyouts, and PE growth funds really stepping into later stage rounds. Is PE filling a liquidity gap that public markets have failed to close, or is it creating a shadow exit market that keeps the best companies private longer and makes the listing problem worse? So. Maybe John,
I think
start with you.
It's definitely plugging a bit of a gap, but as someone said at the start, you can only keep going so far. I think there's been a proliferation of earlier stage private equity and mid-cap private equity funds have sprung up, and a few have ebbed away as well. And they're all pretty much awash with cash. At times, probably less quality businesses in the market. And I think because post-COVID and a lot of things with budgets and uncertainty in the market, people's financials have perhaps not been as steady as they maybe once were. In the UK, people's views have changed on actually profits quite important now, margins are important, let's look at your KPIs. People are kicking the tires a lot harder than they once were. It's not all about growth. If you're deep tech, it's slightly different. People are looking for, but the rates of change with AI is also meaning people are kicking the tires there. And so, private equity have stepped in, ventures stepped in as well, and angels have kind of ebbed away, but then you've got the British Business Bank and others who've also stepped in. And I'd encourage any earlier stage companies in the room that are struggling maybe to find money below kind of 2 million checks or 2 million revenue to explore your options with British Business Bank backed funds. There's Foresight, there's Meagan, there's lots of other funds, and they are the first step really to then going on your journey. And that journey has broadly now become, I think, more going to mid-cap private equity, where it gives optionality if certain people want to exit, and then to the slightly larger caps, and then on from there. But there's also certain sectors, Huel's a good example actually, where private equity firms in the UK, US might be slightly different. I think the risk appetite's a bit different still, but we're still a bit old school here, and we don't like risk, and we don't like consumer risk. And so there are certain household brands that are definitely better suited to an IPO or a slightly different route where they're struggling to raise private equity money.
Any other thoughts?
I'll just add, to follow up on John's point, in addition to BBB-backed funds, explore the VCTs and EIS funds. They've been calling me non-stop since 21 looking for deal flow, both in private markets and public. There's a lot of dry powder out there. And I think neither public markets or private markets are public. They need each other to coexist and to survive. And we're here to provide liquidity to many of those PE funds. And there will be companies that struggle in public markets that need to be taken private. And firms like Thoma Bravo have done a fantastic job of restructuring some of these, consolidating these companies, doing stuff outside of the public markets. The world's going to get a lot more competitive, and that's an advantage for founders. With Pisces, you can now take a company and put it on Pisces and do a restructure there. You don't necessarily need to rely on private equity so much. So definitely explore those options.
Awesome. And so maybe Michael, you brought up tokenization as an example. We've talked a lot about like the sort of current landscape and not so much into the future. So maybe as one of our sort of closing questions here, as you think about like the next 3 years in the ways that European companies are accessing liquidity, like what's the biggest change that you expect to see 3 years into the future? And what's the one thing that needs to happen in order for that to come true?
Well, I think one thing you'll definitely see is just there is a fairly large number of companies in the pipeline that have been private for a very long period of time. And a number of those very high-profile names will likely go public. A number of them have been written about, but I think seeing that kind of log jam of companies go public will be a very, very important indicator in terms of the rest of the pipeline. Because that will have a very clear signal to founders and to other entrepreneurs in terms of what the performance of these companies look like in the public sphere. Because the transparency aspect of is going to be extremely important. So I think the actual pipeline of companies going public is going to be important. That's one. Second, I think just the technology around the infrastructure of markets is going to change dramatically. And so tokenization, I think, being one important part of that. But even in the US markets, away from tokenization, we're moving to much more extended hours as far as trading goes. So starting in December, markets will be trading 23 hours a day, 5 days a week. A lot of that is in response to demand that we see from Asia as far as clientele base. And that's going to add to, on one hand, just increase retail presence and also just increase liquidity into the marketplace. And so I think, again, going back to the idea of just this healthy tension that you see in terms of public markets, private markets, that's all great for founders in terms of being able to have optionality around how they think about monetizing their investments. And it's also good for companies as well as they think about just trying to get the most efficient forms of capital that are raised.
Yeah, so I think one structural change we are expecting to happen. So today Europe is underfunded on the growth stages, and so Europe receives probably like half of the funding in growth stages compared to the US, and half of this amount comes from the US. So what we are seeing today is that emergence of growth, very large growth funds that are finally going to support more companies to scale. This will result in a larger number of successful companies out of Europe. And as a result of this, more of them will be thinking about IPO. And New York is probably, the backlog is already quite high, so we cannot expect all of them to go to New York because it's just not possible physically. So what I would expect that many more will decide for good reasons also to stay in London Stock Exchange and other European stock exchanges, which is fantastic news for us. Maybe some of the most prominent players will still try to list in New York, but I think the amount of really successful companies will drive this need for local public offering as well, and I think we will see much more of this.
Completely agree with those points. Look, we're sitting on the biggest pipeline since about 2005 at the London Stock Exchange. Looking forward to helping these companies go public. The main areas of focus for us are twofold, right? Meagan touched on this earlier. First is culture. I was at dinner the other day, asked around the room, who'd invested in a junior cash ISA for their kids. Everyone's hand went up, right? We want to get more of that capital, retail capital, into the stock market. We're also working on tokenization, extended trading hours, and also education to help facilitate that. The other massive unlock is pension funds and insurance funds. Historically, UK, European LPs have been missing from GPs. They've also been missing in UK equities for a long time. And what we're now seeing is a wall of money coming back into all markets. We're already seeing the British Business Bank deploying as well, crowding in some of the pension funds. So I'm hugely bullish on this, and I think you're going to see a lot more listings as a result.
100% agree with that point as well, the pension wall money. So there's going to be probably in our world and private equity venture world, it's going to be a lot more money swashing around, but I think fewer funds. I think you'll see a few funds come and go. And if you're looking to raise money at that level, I would implore you to speak to the ones you think are going to be around in the next 5 to 10 years and have got a sustainable track record, then perhaps not unicorn hunting. That's probably the safest bet for your business. I think those funds will be well capitalized and then looking to make sort of good returns. It's a good vintage where there's uncertainty for most funds, and so a lot of those will probably be looking towards IPO and other routes. And the best thing I would give as advice if you have a business is focus on your fundamentals. If you have a profitable, good quality business that's ahead of AI and you've got the answers to all the questions on your KPIs, you should fundamentally be able to keep raising money privately for as long as you need until you're optimized to go an IPO or pursue another form of exit.
Awesome. Well, thank you guys so much for your thoughts here. We have time for probably 1 or 2 questions from the audience. I see we've got a question back there. Maybe we'll start with, yes, you. In suit.
Good afternoon. Thank you for your time for today. Alex Petru from Consulco Capital. This question is for Tom. As private equity has moved more from niche alternatives to a more mainstream asset class, how are GPs and LPs thinking about liquidity solutions? And do you think the market is pricing liquidity risk correctly at its current spreads?
Is that for me, that one? Yeah, cool, no worries. So I think there's, if I answer your question correctly, I think it'd be more secondaries and things like that, if that's what you're saying. And then, sorry, is your question around how our backers basically pricing the money they give us?
How the market is currently pricing private equity and how you're seeing kind of companies with private equity, if they're being priced correctly by the market? Yeah, good question. Actually, you guys will probably have a view on this as well, but I think there are a few funds who shan't be named. It's all really dependent on how you value your assets internally, like what people view your book as being worth, and you're usually audited, and so really it should be a reflection of the reality of kind of sort of Bloomberg metrics, whatever you're using, and then you're audited by Deloitte. So they should be theoretically priced fairly, but I do think this whole view now on unicorn hunting has gone away, and so there's probably more value attributed to the ones that are going to be around a little bit longer. I don't know if that broadly answers your question, or if you have a view of how you see them worth valued your side.
we've got a few listed funds on our market, and I think those that are going to be around in a while, like the Scahalian Fund, backed by Bailey Gifford, are trading at a premium to NAV. Seraphim just raised 120 million last week, 45 million from retail, again trading at a premium to NAV. So I think the top end of PE, where got demonstrable track record, they've had exits, will definitely get valued appropriately. But I think there will be a bit of a cleanup exercise, and not everyone's going to survive this.
Awesome. Thank you for that question. We have time for one more question here. This gentleman right here.
Thank you very much. So this is a conversation that happens every time, every conference you go to. How do you get exits, right? My name is Raj, by the way. So I've invested in UK, Africa, a lot in Africa. So the question I think I have is, increasingly people are now talking just about one stock exchange. So we're doing Lagos, Nairobi, Lagos, Johannesburg, Lagos, UK, right? And maybe it's UK, New York, I don't know. My sense, and I've got the scars to show for it, is that Africa and US is, as they say in my country, bad curry, right? Because no African company that has gone to US has actually done well on the stock exchange. So my question to you is, if you are an African founder today, but could apply to any founder, if you said, well, don't just look at one option, look at all your options for liquidity in terms of public listing, what would your advice be?
I mean, I would say, just as a general rule, for most founders and most companies, when they go through that process, they're not looking at it through the lens of one exchange versus the other. So I think the first lens is just for the company as a whole, is the business at scale, and what are the comps for that business? So if you're trying to grow your business globally and you're trying to become a global competitor and you're looking at the comps that are going to be above a certain scale, whether it's from a revenue perspective, a growth perspective, or a margin perspective, then you're probably looking at more global markets or global exchanges as opposed to local exchanges. That's just kind of the reality, because you want to get the higher valuation. Now, then it comes a question of, okay, now you want to try to actually look at whether it's London or New York or Amsterdam or Hong Kong. And then it becomes a question, well, what are going to be the comps that public side investors are going to likely compare you to in that marketplace? So if you are going to be compared mostly to comps and you have some business mix or profile that may have more of an appeal to US-based investors, then that's probably going to be the answer. But most management teams are not taking the opposite approach of trying to go through the lens of exchange first and then look at the marketplace. They're trying to go through the lens of looking at their business fundamentals and understand the growth trajectory and understand what the actual comps are going to be in the marketplace, and then look at where the right exchange listing venue is going to be. So I would say, from the standpoint of African founders specifically, the big challenge that you tend to have is, on one hand, you often have businesses that are very much focused strictly on their own local market. So if you're a US-based investor, it sometimes can be difficult to understand when they look at a screen of, let's see, use fintech as an example, 25 other fintech companies, and they're trying to understand, well, how do I compare this company versus the other 25 publicly traded companies that are in the US market? That's a slightly different profile if the company may have done an acquisition in the US, where there's actually a segment of their growth which actually does align with something that is much more along the lines of something that they already own. So I think it's very much company dependent, management team dependent, and then ultimately driven from there based on the exchange venue.
Can I just add one other point to that, Michael, which is, we've got about 120 African companies listed in London, and I think, if you're a company, nothing beats home market advantage, right? So if you're based in Nigeria, you've got to look at the Lagos stock market. If you're in South Africa, you've got to look at Cape Town. But also bear in mind, London could be a fantastic second home. And we've had Helios Towers, we've had Airtel Africa, have been fantastic success stories. I mentioned Bank of Georgia, Lion Finance earlier. Zero revenues generated from the UK, but the UK has been a fantastic place which has supported that business. I think scale and center of gravity, two important parts of that equation too.
And events too. Didn't you guys host an Africa Summit last year, right?
Yeah, we've got, it's back next Friday.
Perfect timing, not a plug at all. All right, well, thank you so much. Let's give a hand to our panelists for joining us today.